Well, this is a conversation I have with my wealth managers, the guys who manage my pension fund. And I'm like, your job is what it says on the tin, wealth manager, right? Your job is not, dollar US retirement fund. It's wealth manager. So if I'm up 20% in 5 years' time on my S&Ps, but the dollar's down 50%, and you've done a crappy job, right? Because my global purchasing power is down, right?
Okay, welcome to Resold Riffs. It's actually been a little while since we've had a Riffs, and it's been an even longer while since we've had Julian on. Those who are tuned into markets or to Resolve Riffs will know Julian. He's been on a couple of times before. Julian Brigden being the president and founder of MI2 Partners, and I think probably a member of the League of Extraordinary Gentlemen as well, Julian.
Yeah, in my dreams.
Overall market superhero, here to share his experience and wisdom and, what's been going on so far this year and how this is likely to play out over the remainder of the year and into the future. So Julian, with that, welcome, sir.
Welcome.
Thank you very much. Thank you, gentlemen. Thank you for having me on the show.
Richard, too, my compatriot. Welcome, Richard, and thanks for joining me.
Thanks, Adam. Julian, it's been an interesting start to the year, eventful to say the least. How would you describe the events that have taken place so far, and how do you see the state of the global macro space right now as it pertains to the major asset classes and where you see the most glaring mispricings and asymmetries?
So, look, the first thing I'd start off by saying is, global macro is one of those disciplines which most of the time, most people don't really need to pay that much attention to because it doesn't move so much so quickly. Clearly, when we get political interference and truly tangential historical events, which I think is what we are seeing, clearly it can change quite a lot and it can come to its fore. And we think we've been heading into one of these inflection points for a while. So in the middle of sort of last year, and I think it's important to stress, this is not kind of a timing call, but you need, when you have institutional clients like we do, big institutional clients, one of your jobs is to kind of talk about bigger picture themes, get sort of share of mind. And then, as you hone it, that sort of thesis, you get to a point where you can sort of say, okay, here's the trade and it's today, slot the thing. And so really in the middle of last year, we started to talk about what we thought was the reflexive nature of US exceptionalism. So this sort of, and I will say, I think there's actually very little that is truly exceptional when it comes to the US, unless you call spending money like a drunken sailor exceptional. I think what we've ended up with is this cycle, which really started with a vengeance in 2014, when the dollar started to diverge and really appreciate when Europe and Japan moved into negative interest rates and the US actually ended quantitative easing. And this wall of global money went piling into US assets, looking desperately for some sort of return. So money goes piling into US corporate bonds because European corporate bonds were yielding nothing as the ECB is going into negative interest rates. And US corporations took that money and started to buy back stock. And then US stocks start to outperform and the dollar is rising at the same time. So foreigners are making this sort of 2-for-1 trade, this classic sort of, unhedged long dollars. This is all great. And then it drives these sort of three economic effects. You get a what we call hyperfinancialization. So this incredibly tight relationship between the employment market and the labor market. So between the equity market and the labor market. So as the equity market starts to rise, employment rises. Secondly, you get a wealth effect, which is enormous because top 10% in the US are basically 50% of all consumption now. And then you get this growing current account deficit, which sucks in more money. So you get this sort of effect, and you suck in and you suck in and suck in more money. So we had this cycle where the whole world has piled in money to fund our egregious spending here in the US, running, a 7% of current account of fiscal deficit and a 4% current account deficit. And those are all things that you can be in part, or certainly in the current account basis, have to be all funded by foreigners. So all the money's sitting here. So what we were looking for was a catalyst to start to change that around. And the Trump administration's election was that catalyst. We thought that people were being overly simplistic in terms of their read of what the Trump administration really meant. And we wrote the day after the election this piece called Assumption, Confirmation, and Reality. And we said, we're going to go through 3 phases. We're going to assume that it's Trump 1.0 again. So we're just going to go and buy stocks, sell bonds, buy dollars. Then we're going to get to the middle of December and we'll start to run out of a little bit of oomph. But then all the soft data, all those animal spirits will go, whoa, it's great, fantastic. And then we'll get to the inauguration. And when it gets to the inauguration, we're in for a shock, because they really mean what they want to do on tariffs. They really mean about what they want when they say Wall Street's had it too good, now it's Main Street's turn. And none of these things are structurally necessarily so bullish for the US equity market. And in particular, what worried us as well was this idea about the dollar. Because the dollar, gentlemen, is one of the key underpinnings of US exceptionalism. And with foreigners sitting on a whopping, these numbers, guys, are bloody mind-blowing, $26 trillion of net investments in the US, right? Up, from basically 55% in the last 5 years, right? That if you start to weaken the dollar, and in other words, weaken their returns, because a lot of this is not FX hedged, the risk is you're going to send the money home. And that was kind of our bet. That, as people realize what the agenda was of the Trump administration, now we can have a debate as to whether that agenda is still the agenda, right? But you were basically supposed to be short US stocks, short bonds at some point, and short the dollar going into the start of the year, not the other way around. So in our Alpha Capture book, we've had a really excellent start to the year. We've killed it. And, that's kind of where we are. And I think the question now is, there's sort of twofold questions. Has Trump pivoted? Are we going back to kind of, we thought we were going to try and address these fundamental issues, but we kind of looked over the precipice as to what those would actually entail, and we'll lose the midterms. And so, forget it, right? And so we're just going back to good time Trump, spend a lot of money, right? Don't address any of the fundamental issues, backtrack on trade. I was only kidding. And then, if that's the case, whether that's enough to keep this game going, this US exceptionalism game, this sucking in of foreign money to fund extensive overvalued assets, or whether you've just done so much damage now that you can't put Humpty Dumpty back together again.
I think there's also been some actions by non-US players that may have caught markets a little bit by surprise and amplified the effects that the tariffs might have had in isolation. For example, the fiscal expansion unlock in Europe, and in particular in Germany, and their declared intentions and forging into law huge fiscal expansion over the next 5 or 10 years, like unprecedented post-war expansion in Germany, and also Germany's implicit encouragement for the rest of Europe to unleash their own fiscal space, and China reacting with their own major fiscal and banking and credit unlock, right? So you've got other jurisdictions who are powering up their economies from a fiscal standpoint, while the US for a while seemed like it was going to be suppressing its own growth and capital favoritism agenda, right?
So you're absolutely right, Adam. But in a way, they all come back to this Trump administration. I mean, Europe is only powering up its defense spending because the Trump administration has withdrawn the military protection of umbrella, right? I mean, this is something that we can discuss. I think is hugely profound when essentially the US is saying, we've hit what historically, if you look at any tax system, is called peak imperial overreach, right? You've basically reached the limit of your ability to maintain the empire, right? So the US has basically told us they cannot afford to defend Europe anymore, right? Now, whether you can argue it from it's not right that we do, it makes absolutely no difference. They're just not going to do it. And that's going to have inordinate consequences because Europe is going to have to increase its spending. And then you have to raise the question, where's that money going to come from to do that, right? Where is their piggy bank, right? And then on the China thing, look, I mean, we've told the Chinese, to quote Stephen Mirren, that they are our greatest adversary, right? As though they didn't know that already. And the problem there is they are also the world's largest provider of savings by an inordinate percentage. I mean, they are basically 28% of global disposable savings. And we just told them, you're our greatest adversary. Why would they be investing in the US anymore? I wouldn't. I mean, we've already seen the FT story where they talked about not putting any more money into private equity, and they were a big player in private equity. We've seen talk of other sovereign funds in Asia being less interested to buy US assets. I know of one who said to one of my clients, they're not increasing their assets in the US at all, right? And, all of this against a backdrop where we're continuing to spend money like it's gone out of fashion, right? And just think it's our unalienable right to run these deficits. We'll see.
Doesn't it also make sense to consider that the U.S. stock market outperformance versus the rest of the world has been enormous, partly because of U.S. growth and the strength of the U.S. economy, but also partly due to, say, non-fundamental reasons, whether the buybacks, whether the rise of passive investing. That's one of the other proximate causes that has been pointed as having contributed to that. We saw, after a tough 2022, we saw 20+% increases in the S&P in 23 and then in 24. Isn't it somewhat inexorable that there was going to be a change in leadership across the different stock markets and the different jurisdictions in terms of growth? And I pair that with this idea of U.S. exceptionalism that you pointed out that is no more. The Pax Americana and the unipolar moment is kind of a blip in history. We've typically had, at least in modern history, multipolar global balances, if you will, and the U.S. is now decided, it seems, to retrench, partly because it sees there's an exhaustion in the U.S. versus the rest of the world.
Right. You've hit basically what you're talking about is we've hit what in economic terms is referred to as Triffin's dilemma. So Triffin's dilemma is a point that only and is an issue that only applies to the reserve provider, where the perceived benefits or the actual benefits of being the reserve provider outweigh the perceived costs or actual costs and are no longer compatible with domestic policy. So I think all of those are absolutely true. You can, whether you can argue, that the costs or the benefits are really less, I think we're going to find out over the next few years that we may have underestimated the benefits that we derived from that. And that's going to come as an incredibly painful reality check for the US. But that's the fact. Now, historically, when you go back and look at PAC systems, and there have been 7 through history, when you hit this tipping point, then that's it. Peak empire, peak hegemonic power, peak reserve currency status, and you move slowly into the next phase, which you, to your point, you typically is a process where you get this sort of multipolar world for a bit. It's very unstable, right? And then we come out with the next PAX provider. But if we're going into that point, then it's got, the consequences are enormous, right? I mean, Europe has, you know, I'm not really concerned about who is right and who is wrong in this debate. Whereas if you're a Republican in the US, you'll say, you know, it's cost us a lot of money to defend Europe. True. But if you're a European, we've foregone a lot of consumption to funnel our savings back into the US so that you can afford the defense. As a Korean client of mine said, Americans think that this is just a one-way street. But in Korea, we live in little apartments. And in America, you live in big houses with swimming pools. So maybe it's about time that we siphon less of our savings back to you and we live in bigger houses, right? I mean, this is going to come as an inordinate bloody shock to the US. And to your point around this, and this I think is a structural factor, right? This is not going away. I mean, Adam, you were just raising the point. You're talking about trillions of dollars of multi-year defense spending. If we're going back to 5% of GDP, right, defense spending, apart from the huge DVO1, you know, duration, but, you know, deluge you're going to end up in global bond markets, right, which is going to displace, you know, money from elsewhere. You know, Europe is going to have to do things to get money back into Europe to fund these things, right? So it's either going to have to offer, you know, incentives to buy European defense bonds, right? And then where does that money come from? Well, my guess is it'll come out of the treasury market, right? You know, because that's where a lot of the money is. You know, European stocks become more attractive. Well, where's that money going to come from? Well, US stocks, because that's where all the money is, right? So you put this together and then you look at this sort of what I think is this reflexive nature of that, and you link that together with indexation, right? And I think, you know, Mike Green's done a lot of work, and I don't know if you probably had him on the show, talking about the sort of self-reinforcing nature of indexation. So, but he's talking about the micro. What I'm really talking about here is the macro self-reinforcing nature of this sucking money into the US. But it is dependent, gentlemen, on that ongoing dollar strength, right? That ongoing dollar strength. Because if the dollar is weak, right, and at the beginning of the year, a European investor watched, if they were unhedged in the S&P, they watched their total value of their portfolio drop 25% in 6 weeks, right? In 6 weeks, okay? If the dollar starts to materially weaken, which is something that the Trump administration wants, that money is going to leave, okay? Secondly, if US assets start to underperform, which they will generally do in a weak dollar environment, right? I mean, Morgan Stanley came out with something today, and I'm sorry, I've got great respect for some of their work, but that was the most asinine piece of research that I've read. And it's that classic stuff that's aimed at Americans and not the rest of the world. Oh, the S&P is going to go up, right? Because it'll be good for corporate earnings, but the dollar's going down a lot. Well, this is a conversation I have with my wealth managers, the guys who manage my pension fund. And I'm like, your job is what it says on the tin, wealth manager, right? Your job is not, you know, dollar US retirement fund, it's wealth manager. So if I'm up 20% in 5 years' time on my S&Ps, but the dollar's down 50%, and you've done a crappy job, right? Because my global purchasing power is down, right? So you're threatening US assets because, you know, you get a weak dollar, typically other assets outperform, right? Growth typically massively underperforms in a weak dollar environment. You buy value, and the US equity market's a very growth-focused market. Secondly, PEs tend to decline when the dollar goes down because that foreign money is what's bid up PEs at the same time. We've gone right back to the PEs of the dot-com bubble, and it's no surprise that the dollar was on the highs at the dot-com bubble. And you look at PEs from 1995 to 2000, 2002, and they just went up along with the dollar. So, and then thirdly, if we go into a recession, the current account deficit is going to shrink and the money's going to go home, right? Or if they shrink the current account deficit because, you know, they impose all the tariffs and so on and so forth, we don't need the money here. And this concept, I think, is something that I've really struggled to understand, why I get different responses from foreign clients and American clients. So foreign clients will go, well, it's just mechanics. If you shrink the current account deficit, less money from the rest of the world has to flow into what's referred to as the capital account surplus to balance it. And so US assets will underperform. It's not a controversial statement. It's not a political statement. It's just bloody mathematics. Now, when you pose that to Americans, depending on, you know, some degree their politics, I think some degree self-interest, they don't want to acknowledge that, right? Professionals understand it, but even they don't want to acknowledge that, because they'll say things, yeah, but we'll end up with a strong economy, right? If we get the trade deficit down, if we get the fiscal deficit down, if we bolster manufacturing in the US, if we raise middle-class incomes, all of which are highly, highly laudable long-term aims, don't get me wrong, we're going to end up with this stronger economy, they say, and so equities should be strong. And the answer is absolutely not. They are absolutely nothing to do with each other, right? Mm-hmm. Korea has a large current account surplus, arguably strong, far less of a divergence between the rich and the poor, right? All of those things, big manufacturing sector, et cetera, et cetera. I can't remember the last time that anyone talked about buying Korean stocks, right? Their kids
look across the world at any surplus country, right, and their equity market has been in a quasi-depression for 15 years. Yeah. And it's the deficit countries where the equity markets, primarily US being the primary deficit country, where the equity markets have thrived, right?
Yeah.
And I do think it's important to recognize that you can have some of the driver of the decline in asset prices can be just driven by actual capital account dynamics, right? There can be just, and I think, you know, you were describing that, where just foreign investors are either putting foreign savings into US assets at a declining rate,
right,
or are physically removing US assets and moving them to other jurisdictions, right? Those are kind of two more aggressive versions of the same dynamic.
You can just have a situation where the assets just disappear.
Right.
Right, because if you didn't hit the bid at the high in January,
accounting identity, but what I'm saying is some of it can be driven by current account action, and some of it can be driven by capital account action. It has to add up mechanically, but there's a bid and an offer in there on both sides, right?
Correct.
And I think
Correct.
I think it's going to be driven on both sides.
It's a little bit of chicken and egg situation. Yeah. It doesn't, you know, for example, I think in 2008, I think a large part of the crisis that actually happened, which was a different setup, right? This is where the dollar went up and not down in a risk-off environment, is because actually foreign assets were more expensive relatively, had outperformed US assets up to the highs.
Massively
outperformed. And so all the money was sitting abroad. And then what happened was the US current account deficit started to shrink quite early in like 2006, 2007 as shale came on board. And as that shrunk, that tightened dollar liquidity in the rest of the world, right? And so we got this risk-off event. And I think, you know, so you're absolutely right. It's chicken and egg. Which one goes first? Is it the capital account that drives the current account? In other words, foreigners just pull their money and they just won't vendor finance the US. They won't fund little Johnny to go, you know, the millennial influencer from Iowa to go to Santorini and stand on the cliff with 500 other American influencers and ruin it for everyone else who wants to go there, right? I mean, there's a sense, I mean, you know, so yeah.
But this is a good reminder, Julian, of the cyclical nature of these capital markets that we study so carefully, and the fact that whether it's one catalyst or another, whether it was the Trump election and his tariff tantrum or something else, there had been a major imbalance in some of these
Correct.
asset
Correct, Richard.
performance.
I mean,
But I am
really
curious,
just looking for that tipping point, that trigger, right?
that's right. If it wasn't this, it might have been something else. But at the end of the day, I am curious. We've seen the S&P round trip. Treasuries are somewhat stable depending on the maturity, but it hasn't been cataclysmic. I guess the long end has started to weaken again. Yes, yet being the operative word there for sure. But the U.S. dollar definitely has been the big loser so far. So what are equity markets missing from a signaling mechanism to actually perform the way you would expect?
Look, I mean, arguably nothing, right? I mean, US equities are underperforming, certainly in euro terms, right? They're already underperforming. I mean, if you look at European equities against the S&P, in dollar terms, they have broken out of a massive long-term trend line. Let's see if this thing works where we try and share a chart. Okay, so this is Euro stocks ETFs, so listed in the US in dollars, right? So FX neutral against the S&P. Now, this is a log chart going back to 2007, and we blew through that trend line in March. We took out basically the best part of a 20-year trend line. So to me, this is done. I was really hoping for a retest to pick up more, but I just think this trend is reversing, and it doesn't really matter whether it's going to be driven by currency, right, which will lead the Feds to outperform, or it's going to be driven by US assets correcting lower or sitting here as European assets rally for the next 5 years. And Richard, to go to your point, these are cycles, right? We see these cycles. I don't know if I flip to another chart. I mean, broad dollar cycles are the norm, right? They are absolutely.
It's remarkable the degree of U.S. equity outperformance relative to the rest of the world. It's absolutely astonishing.
It is. And how long it lasted.
Correct.
Yeah, how long and how persistent.
Correct.
And how just the magnitude of it.
Yeah. So look, I mean, here's the dollar going back to 1972, right? So we get a 50% correction. You can't see it because the chart doesn't start. We get a 50% correction in 1972. Then we get a 60+% rally. Then we get a 43% decline. Then we get a 40% rally. Then we get a 38% decline. Then we get a 50% rally. So why not another 30, 40% decline? I mean, I'm not talking about, I think this is very important to say, I'm not talking about the demise of the dollar as the reserve currency or anything silly like that, right? I'm simply talking about a decline in the value, the exchange rate, right? In fact, I think, the ambition of the Trump administration is at the end of this to have an inherently stronger dollar, right? Because if we keep spending money like we are, the dollar's going to be a piece of toilet paper, right? And, and I think that's kind of where, it just doesn't preclude a decline in the value of the dollar. But that's an important variable in global markets. In fact, it's really the probably most important macro variable. If you get the trend of the dollar right, you're pretty much going to get your asset allocation right.
Right. And obviously prices are set at the margin. So regardless of the volume that we would expect at the end of this journey of assets to flow out of the US, as prices are being set at the margin, marginal appetite for the global reserve asset and currency seem to be diminishing. But to go to your earlier point and on the reflexive nature of things, you have China, you have Japan, you have so many emerging economies or just global economies holding US treasuries as a foreign reserve asset. do we expect these countries to light the reserves on fire and start divesting? Because we also understand that as they move towards the exit, we would potentially cause a huge decline in treasury pricing. So
the sovereigns,
how do you see that dynamic?
So I think you've got to really split this between sovereigns and private investors, because sovereigns don't really hedge, right? They don't. I mean, we've seen a diversification of sovereigns, into gold. There's no question, right? We saw the S&B, which is a great trade. We'll see how it pans out, but probably be a better trade than treasuries, move into US equities for their reserves, right? We've seen essentially the Norges Fund do the same, and other entities. But when it comes to their sort of core treasury holdings, they're supposed to be reserve stabilization funds, basically, or sort of currency stabilization funds, and they're not really going to hedge those. They might not increase them very much. They might decrease the duration of them, right? Which is why, Stephen Mirren's trying to propose that, he forced countries to come and buy 100-year bonds that yield nothing. Good luck with that, because that's a default. But I don't think it's that. I think what you're seeing is, in particular, is this right here, right now. I think you're seeing this big equity float of global equity money that has come into the US, which rarely, I was in Europe joking with clients that, and I was in currencies for most of my professional career, as opposed to this amateur shit that I do these days. But sort of when I actually sat on a trading desk of a bank, I was in FX, and there were whole decades where we never spoke to an equity fund, and then something would go wrong, like for example the ERM crisis in the early 90s in Europe, and I was sitting at Lehman at the time, and I was getting these phone calls from these US funds, in Boston or New York, going, so we got this, all these Italian stocks, and we didn't do very well last year because of the lira, right? And you're like, oh, we can help you with a hedge on that one. Cha-ching, 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 cha-ching. But the point is these equity guys generally don't hedge. I think we are seeing some of them hedge now, but I bet you they're having to discover who their contacts are at the major bank, on the FX desk, right? And some US equity investors will not hedge. So in those guys who will not, and particularly the general public tends not to, those guys will just hit the bid if the currency moves too far and undermines the value of their US stock holdings in their own currencies.
Right. So what countries, what jurisdictions have capital markets with enough depth and breadth, enough volume to absorb a portion of this wall of liquidity were it to decide to find a new home?
So this is an interesting question. So I get this one a lot, but there's no alternative. Okay.
Be creative.
There was arguably, you could argue in 2008, there was no alternative to having your money in the rest of the world when foreign stocks were almost 3 standard deviations more expensive than US stocks, right? Well, guess what? If all of a sudden everyone wants to trade European stocks, then liquidity is going to improve, right? Number one. Secondly, this sort of gives you this sense of, that we've sort of discovered here in the US, this concept of perpetual economic motion, and it's cycle free, and even more and more money can only come into the US, right? And last year, Bridgewater had this great stat where they said, 70 cents of every dollar went into US, of every dollar that went into global equities went into the US. So what's it going to go to? 80? 90? So what happens when it goes to 100? Right? Do we just go, okay, that's it. It just stays here forever. We never have the answer is, at the moment, there's not many markets that are as liquid. But what we will discover is we can hedge the currency quite quickly and quite easily, right? So if you are that, Swedish pension fund and you haven't hedged, your Swedish krona, then and you're long a lot of US tech stocks, you're going to first probably do the currency. Then you might buy a put on the NASDAQ to protect you as you start to chivvy up the kind of position. So there's ways of sort of doing it. I'm not suggesting it's going to be clean, but as I was saying to Adam, I think people forget that in this process, people lose a lot of money, right? So there is less money to rotate because the money's gone. You need to use that great South Park analogy, right? And it's gone.
It's gone.
Right? I mean, it's just true. I mean, if stocks go down 30% and no one hits the bid, then the amount of money that has to get transferred is down 30%, right? Because the money was never there.
And what role do you see? Gold obviously has had this massive rally, and is now right in the center of the Overton window of where people see an alternative. What else are you looking at as alternative from an asset class standpoint? Do you look at other precious metals? Do you look at energy? How do you think about that problem? Is there a role for crypto in any of this?
I mean, look, there's potentially a role for crypto. I have structural concerns about crypto. We could address those if you want to, but look, I'm still quite concerned that crypto is this very sort of highly correlated, risk on, risk off asset, right? So to me, I'm not convinced that it's, if we were to see a major correction in US stocks, I'm not saying, but let's say, that crypto really outperforms. I just don't know whether that's the case. I still think it's owned by a lot of people who own NVIDIA stock and this sort of stuff. And it's owned by the market now. So it is subject to risk off or VAR events. I think that gold is a little unique. I do want to own all of those other assets that you talked about. I want to own emerging markets. I want to own overseas stocks. I want to own commodities outside gold.
Right.
But here's the problem. Typically, when you're in a capital rotation event, which I think we are, right, out of the US and into other things, right, the initial phase is what I refer to as a nasty correction. So if you think about, when you see huge divergences, there are one or two ways that these divergences can normalize. You can get a nasty divergence, normalization, where the expensive asset just craps out, right? That's it, right? So the S&P just drops, foreign assets, outperform. But it's rare that in those scenarios, they absolutely rise, right? So if you look at 2000 to 2002, silver massively outperformed the S&P, but it still got drilled, right? You still lost money if you were outright long silver, right? So what you really are waiting for is the nice rotation phase. And the nice rotation phase is typically when the Fed starts to cut rates and you get that nice, warm, fuzzy release of weak dollar liquidity. Like that's the grease that, oils the machinery of global finance is the dollar still, and it will remain, as far as I'm concerned, for a while. But when it drops in value for the right reasons, right? Because the Fed is cutting, maybe they're doing QE again, who knows, right? Then you're getting that nice liquidity flooding into other assets. And that's when everything rises. So US stocks will bounce, but less than emerging markets, less particularly when you take the dollar into account, right? So that's when I really want to own them. And I don't think we're there yet because we have not seen that capitulation at all.
Liquidation. Well, we haven't really seen liquidation. So at the end of the day, I think what you're describing is, and it's something that we've observed here at Resolve as well. Initial phase, you sell first, ask questions later. Anything that has a bid gets whacked. People are just raising cash because of the uncertainty of the scenario that is unfolding before their eyes. The second phase is once you start to put that money to work, and then you start to see which jurisdictions, which asset classes are going to be favored. So in your view, once we haven't even really seen that first phase, we haven't really seen capitulation. There's this old adage that you have to see some kind of, critical events, some major bankruptcy. It's typically the case that we see something like that taking
before
place.
the Fed comes in and goes,
Right.
Here you go.
Someone cries uncle.
Yeah, someone cries uncle. I mean, maybe it's the US Treasury market, but we'll see. Hope not.
Right.
But it could be. But yes, that's typically the case when you can truly own assets outright and go to the beach for the next 5 years.
So commodities, emerging markets, and then to a lesser extent, some of these other esoteric asset classes that are still you have some doubts.
I mean, look, the only problem that I've got with crypto, right, which is really what you're raising, as I said, I think it's very heavily correlated to the NASDAQ. And B, let's play a little game, right? And I'm not saying this is where we're getting. So let's say I believe we're in a structural bond bear market, right? A completely structural, it's driven by demographics. There is nothing we can do to stop it, right? So basically, unless we do YCC or yield curve control, yields are basically up and to the right for the next 25 years, right? And my work suggests somewhere between unhindered US Treasury yields are going to be 8 to 10% at that point, right? By 2050. Now, I suspect we can't do that. We can't live with that. So at some point, we're going to end up with we could end up with a crisis, right? Let's say where yields are too high. Let's say the deficit is, or the interest on the deficit is running at 2 trillion, which all that would take is the CBO being more realistic of where the funding costs of the deficit are going to come from, right? If we're funding at 4.5, the deficit isn't 1 trillion, it's 2 trillion a year, right? And, the long end of the bond market becomes unhinged, and the Fed comes in and does yield curve control or QE, right? Then the dollar gets hit, right? Then inflation spikes even further because the dollar gets hit. Then US assets are underperforming in that situation and possibly even selling off, depending on where you are in that cycle of foreigners divesting. And then they have to do really something quite nasty. And the last time we were in a structural war bear market, it was really the sort of post-Second World War period into the 1980s. And the world looked very different, gentlemen, right? We did not have laissez-faire, free, open markets. We had capital controls, exchange controls, prices and incomes policies, where governments literally told you what you could get paid and how much prices were going up. Because that was such a painful environment, right, that governments had to intercede. So let's envisage that we're heading towards that environment and the dollar's getting trashed and, crypto's 200,000, 300,000 could be an amazing trade. Here's the problem. If you have to get to the point to put capital controls on and exchange controls to stop money fleeing the US or some other economy, you have to close down crypto because it is designed to avoid those restrictions. And so you have to turn around to American citizens and say, you can keep your crypto, but you cannot transfer it outside the US dollar system or outside the US, or you close the thing completely, right? So that ability for you to let that liquidity leave the US, they have to lock down. Now, whether that means banning crypto or just banning it to only working, US crypto for US markets, I don't know, but I think that could become quite a difficult event, right? And that's where I worry about crypto and what that does.
Sorry to interrupt, but I did want to take a quick second to remind listeners that while we do absolutely love providing our audience with world-class guests and weekly investment insights, we wanted to remind you that we actually do our best work outside of this podcast. And we try to do this by providing cutting-edge, globally diversified, and systematic investment strategies that are designed to be broadly non-correlated to traditional equity and bond portfolios. So we actually manage private and public funds, as well as bespoke, separately managed accounts for investors that seek the potential to smooth out portfolio returns in the long run. So if you do want to see that theory that we've been talking about put into practice, please do go ahead and check us out at investorsolve.com. Now back to the podcast.
With the U.S. debt the size that it is, and I mean, I think we had maybe 3 weeks where the market began to contemplate the vanishingly small possibility that we may see a reduction in deficits this year before it became obvious that we were just going to double down again on deficits with tax cuts and other features. Why isn't the debasement inflation cascade that you described the base case?
I don't know, because I try and be optimistic. I mean, I think you know, it is. I will say it probably is the base case. It's a question of timing. So you cannot constantly think about that, right? Because if, let's say, you know, the bond market does hold in, right? I think it's got some inordinate challenges ahead, and US equities go to, you know, 6,500, and we keep playing this, and the world does fund it for another year, then you're wrong, right? It doesn't, you know, if you're thinking structurally for 20 years, it doesn't matter. I mean, it's like I've said to my wealth clients, you know, if you've got a client who thinks they, you know, have got a house in the Amalfi Coast as an American and they want to go and retire there, right, because they're Italian or European or whatever, then make sure they've got a pot of cash that's sitting outside the US ready to do that, because in 10 years' time, they may not be able to take the money out, right? So, you know, there's a difference between that trading time frame and that sort of structural thinking time frame. But I tend to agree with you. I don't see how we get out of this apart from acute financial repression, right? And
I mean, even in the event of a recession or some type of major global growth shock where you get some relief on the inflation front for a short time, the fiscal stabilizers kick in. You've got much larger deficits to
coming out of it. Yeah.
Coming out of it. We're already at, you know, near record non-war deficits. As you look across the Japanese bond market, I mean, obviously there's been some attention over there.
Yep.
Rightly so. What's playing out there, is that a canary that we can learn some lessons from?
Really good. That's a really good question. And I really hate it when people say, and that's a really good question, because everyone seems to start their response with that. But that actually is a good question, Adam, because that was on actually our morning debate this morning internally. And so the reason why that's an important question is historically, Japanese money flows are absolutely pivotal to what happens in global markets, because they're very large savers. And, you know, if they start to shift, that's important. Now, I think historically, this would be a very bad sign, this unhinging of the long end of the Japanese bond market. I think it's important, but I'm less immediately concerned, and let me explain why. The problem that you've got in Japan is that you've got a BOJ, which is just not raising rates enough to protect long-term investors. If you look at Japanese inflation, it's 3.5%. Rates are pathetically low compared to that. And what's been priced into the JGB curve, even with the BOJ saying we're going to continue to raise rates, you know, you've got this very, very little priced into the sort of front belly to the front end of the JGB curve. And so you're really not being protected by the BOJ when it comes to the long. In addition, they have a really screwy political setup at the moment with basically a minority government, which is just having to hand out, you know, do the TV to you and the TV to you and the TV to you trade to keep the government together with spending promises. And that's obviously being a problem. But so that setup is what it is. Now, if I thought that Japanese private money was all of a sudden going to say, oh, I'm really enticed by 4% long-term 30-year yields in Japan, I'm going to sell my US treasuries and buy those, then I would be more worried. I just don't think Japanese investors want to buy, like most private investors are waking up to the reality. I just don't want to buy duration, period, end of story. So I don't know whether we're going to see that switch flow. So they sell the US to buy Japan. I think if the BOJ were to get religion and to start to raise rates more aggressively, that might be different.
So walk me through that process, because one thing I've always felt that gets too little attention is that the last time there was a massive rate rising cycle was in the 1970s late 1970s and early 80s, when debt to GDP in most developed countries was in the 50-60% range. And now we're in the US, what are we, 190% or something? In Japan, it's like 300%. So
Fiscal dominant.
I hear people say that the BOJ needs to get ahead of it by raising rates. So they raise rates, they increase the funding rate for Japanese spending. Now, most Japanese bonds are owned by either the BOJ or the postal bank or whatever it's called, right? In Japan. So, and it's the same in the States. Like, it's very different to raise rates to disincentivize the private sector from lending and investing when you've got very low deficits relative to the size of the economy. When the deficits are 200% of the economy, are you sympathetic to the view that maybe raising rates actually may be counterproductive and may actually amplify the inflation channel?
So you are dealing in a much more complex set of, chess game. You are playing three-dimensional chess here, essentially. I haven't quite mastered the 9-dimensional chess that the president's supposed to play. But anyway, the three-dimensional chess, or the two-dimensional, three-dimensional chess, I think, you do start to run into problems. So you're absolutely right. Is there a sweet spot where the BOJ can raise rates? Now, I think in Japan, it's a little different than net savers, right? So you actually boost income somewhat by raising rates. And that you do enough that holds in the bond market and prevents that point where you get that kind of accelerative meltdown in the long end, where the risk is then that you have to do something which then weakens the currency, which pushes up inflation. You have to come in and do yield curve control or YCC again, and then the currency lurches lower. So I think you can end up in that quite nasty, vicious, and then the debt servicing gets wrong. And it gets very messy. So,
well, the other angle in Japan too, right, is that a big reason why people haven't been as concerned about Japanese yen debt is because they have such large dollar reserves. But if there's a concern that the value of the dollar reserves are going to decline at the same time that Japan enters an inflationary cycle at 200% debt to GDP, I feel like the BOJ is in a box.
Well, they also own a lot of their own debt, right? They kind of eat what they kill as a current account surplus country.
But in that respect, you're raising rates. That amplifies the extent to which higher rates feed back into stimulus in the economy, right?
To some degree, yes. So look, the way I liken this is the higher your debt goes, right? Debt to GDP, deficits, whatever, that essentially you're trying to walk a tightrope, right? Yeah. But you're doing it at higher and higher and higher and higher levels. So maybe I think it was a French or a Swiss guy that walked across Niagara Falls or walked between the Twin Towers before that tragic event, 9/11, right? That's what you're trying to do, right? And
you have fewer degrees of freedom available to you to solve the problem, right?
Correct.
Balance.
Yes. Yeah. It's a really precarious setup, but I think, I think Japan in a way is luckier than the US because she's not dependent as much on the kindness of strangers. We have to be very, very, very careful as the reserve provider that this is how reserve systems end, because you lose that faith. I mean, I think, I wrote a couple of months ago, and I expected to get a few months ago, I expected to get a lot more pushback on this. Could we be reaching peak Pax Americana, right? And the analogy that we used was the late 60s in the UK, which may seem bizarre because the UK hadn't been the reserve currency for quite some time. But what was interesting is coming out of the Second World War, the UK was on the winning side. It had an enormous military, it was a global power, but it was bankrupt. So it had all these sort of vestiges of empire, but it just couldn't fund them. And so in 1968, the UK government bites the bullet, and they make this announcement that they're pulling all UK military forces east of Suez, which means that we left the Pacific Ocean and the Indian Ocean unpatrolled by the Royal Navy. The problem is that three of the biggest holders of sterling reserves, and they held basically all their reserves in what was called the sterling area, were India, Canada, and New Zealand. And so as they started to diverge because they were no longer getting that military protection and they had to chummy up to the US, that money starts to leave. And this is where this unique impact of that reserve status comes into play. Because as a reserve provider, you've been used to for a long time having subsidized current bond markets, essentially, right? And you've been used to having that usually quite strong currency, or stronger than typically is. And so as those start to adjust, you tend to get higher inflation. You tend to get higher funding costs, which if you're in a weak fiscal situation, which the UK was, just exacerbate that. And I think people forget how quickly things can spiral out of control, where your deficits are getting more out of control, your public spending is getting more stressed, you're less able to provide that military coverage, you're crowding out that classic term, which we haven't heard since the 70s, but I suspect is coming back, where the need to fund government basically squeezes out the room available for the private sector to fund itself, right? And so you crowd out private investment. So your capex is low, so your productivity is low. So for an extended period of time, the UK basically went through a period where its inflation was higher than its peers, its currency was weaker than its peers, and its growth were lower than its peers. And so the end result was, and this may, surprise some of your younger viewers, even in the UK in the end had to go cap in hand to the IMF for a bailout. Right. So I think this, look, don't get me wrong, I think the Japan thing is important, but I think there's some dynamics there that are different to when you make that comparison to the US, because the US is the reserve currency, and that means the whole world owns your assets. That's how the reserve works.
But it's a critical difference too between the 1968 British situation and the current situation, is that they were operating under a fixed exchange regime, right? So you don't really get crowding out in a floating exchange regime, because the central banks and the treasuries have a lot more flexibility about how they decide to fund it, right?
Okay, so yes, but you're talking about essentially that we get to a point, and we just talked about what's the base case, where essentially you push the yields to a point where it is unsustainable, and we're questioning the solvency of the US government. And that is a point called fiscal dominance, that the central bank then has to cross this Rubicon. And it is a Rubicon. It is something they will not do lightly, right? Yep. Because it is an abandonment of independent central banking, right? They hand the keys over to government, right? Because they move from targeting inflation and employment to solving for the solvency of their boss, right? And I think we can get there. But that then triggers all of those other things that we talked about, right? Where you end up with significantly weaker dollar, arguably, right? Unless you're doing it in parallel with everyone else, right? Significantly weaker dollar, higher inflation, right? So you kind of get to the same place as the UK had under a more fixed exchange rate basis. It just takes you a little longer.
Yeah,
right?
and the mechanics are a little bit different, but
Yeah.
I generally agree. Speaking of funding the deficit, what do you make? I mean, and also, I was laughing earlier when we were talking about oiling the machinery. Speaking of oiling the machinery, what do you make of the way that the Saudis and the Emiratis have been oiling Trump's machinery over
You,
the last few weeks?
you could read that in
in
different ways.
Trump's-
I'm not going there. If you believe about those tapes from Moscow, look, clearly the president wants to achieve a certain outcome. I mean, conceptually, let's say, I'm worried he's walked back, right? We've seen that pivot, but at least the objective is at face value to sort of strengthen US manufacturing and strengthen the inherent economic underpinnings and growth of the US economy. And so those investments are important. Are they playing to an ego? Absolutely. Will they happen? We will see. Will they fund them out of US Treasury holdings that they have? Right? I mean, they're just going to get a big tax break on them. But it's, maybe not the worst thing. So, net is this suddenly we're going to spend, the Kuwaitis are going to divert $500 billion worth of money from their European bond holdings and go and build a data center or whatever the heck. I lost track of, what everyone was promising to do, right? Or are they just going to say, we're just going to take that $500 billion we've got sitting in existing US assets and we'll direct it to there? I suspect it's the latter, not the former.
The latter. Yeah. Yeah.
So net, are we better off? I mean, we'll create some manufacturing jobs, which is great. But if we lose $500 billion from the treasury market when we're pretty clear we bloody need it,
Yeah.
I don't know to what extent do you follow sort of the non-economic elements of geopolitics, but do you think that there might be a defense element to this in the sense that they're trying to bring a lot of these other Arab nations into the Abraham Accords, and perhaps there's an element to this where you're trying to tighten economic ties in order to sort of facilitate this.
Yes,
the diplomatic element of it.
So look, like I said before, typically at this point, Triven's dilemma, that's it, right? Peak imperial power and so on and so forth. Now, the US doesn't want that to happen. They want to try and maintain that status. I'm not convinced they can totally. But there are definitely areas of focus, right? So the US made it pretty clear after they stuck it to the Europeans, or they read the riot act to the Europeans and said, we're not here, right? I mean, this last weekend, the US NATO ambassador said, we're starting talks now as to when we're withdrawing troops from Europe, right? So that is ongoing. They are out of Europe, right? Now, I think as part of that reorg, Southeast Asia, clearly, greatest adversary, China, you got to keep those forces, build those forces up, arguably, and the Gulf, right? So I think there are, there's a change in the mix. So yes, absolutely. I think we're re-emphasizing those areas that we want to place our emphasis.
And to be clear, when you say the U.S. wants to retain their hegemonic, exceptional status, that is more on the economic front and sort of dollar and treasuries as currency reserve asset, less so on the geopolitical and defense unipolarity because they, to your point, they're retrenching from Europe. They are trying to. I think one of the few bipartisan agreements is that, I mean, from an electoral standpoint, no one wants more wars.
Right.
So there's this element of the U.S. needs to spend so much treasure and so much blood in order to be the global sheriff, and that seems to be, squarely in Trump's agenda, that the U.S. will no longer be that player, and everybody else needs to step up. So
I mean, the tragic historical reality of that is when you tend to move to a unipolar world, they're inherently more unstable. You end up spilling more blood, but I guess
multipolar.
Multipolar, yeah. I mean, sorry, it becomes increasingly unstable, right? There's an interesting video going around on TikTok about George Bush in 2011 to talk about exactly that thing and the concerns he has about isolation tendencies in the US and pulling back and so on and so forth, and that being, if you look back at the 20s, that was just a bloody mistake, right? So, okay. But that, to go back to your original point about wanting to maintain, that peak reserve status and so on and so forth, and letting that military thing go reorientate, when those things are inexorably linked, right? You cannot divide those, right? We are able to be the largest military because we have the funding to be the largest military. Right? The UK was able to be the largest military heading into the Second World War. I mean, coming out of the First World War, heading into the First World War, the Royal Navy was was as large as the next three navies put together. Right? That was the value proposition, if you want. Right? And so they are inexorably linked. So if the US is saying, which it appears to be, that we are not the global policeman anymore, certainly not when it comes to Europe and other bits of the world, that we're not that interested. Yeah, we're interested in the Gulf. Yeah, we're interested in the Middle East. In the Far East, right, and Asia, right? Okay. But then you are moving to that increasingly multipolar world, right? Because Europe has to become its own pole, cannot be covered by that umbrella anymore. And then the implications for the flow of funds that have been coming from Europe back into the US are inordinately profound, particularly since in the last 5 years, Europe has been by far the largest funder of US exceptionalism, aka exceptional, irresponsible spending, right?
We could be seeing, though, a substitution effect here where the Gulf countries step up. Yet to be seen whether these headlines actually pan out and all these investments materialize. But it seems like you definitely cannot be the global sheriff without being the global reserve currency and have the global reserve asset. But it seems like the opposite could be true. You might still retain some hegemonic status financially on a global status, but retrench from the global stage as the sheriff. And perhaps, do you disagree?
I don't think so. I don't think you can. I don't think you can. I mean, don't get me wrong. I mean, the US equity market could remain the biggest equity market for a very long time, all of these sorts of things.
Nature abhors a vacuum.
Yeah. I mean, but I don't believe that that's the case, right? I mean, I think if the risk is we truly are, and we're not, right? But the risk is we go through this period where we go through this adjustment phase, right? Where even if it's just Europe that we adjust to financially, right? The consequences of that are enormous because where we're starting from, look, if we were trying to rewrite the ship and we weren't sitting at, US equities versus the rest of the world at 4 standard deviations from the mean, right? Using, basically 55 years worth of data, right? And just to put that into perspective, ladies and gents, you are talking about that event should occur, and I'm being generous here because I'm assuming both ends of the barbell, right? Not just one tail, two, should occur in one day every 43 years, right? So if we weren't starting at the extremes, if we weren't starting with foreigners having a net holding of US assets of $26 trillion, I would think this process could be a lot smoother.
Right.
It's
the extreme position that we find ourselves in today that,
we've adopted,
even if at the margin,
we've adopted an extreme political approach. I mean, maybe we're trying to cool that down a little bit, right? We adopted it, extreme. We went into this assuming that we held all the cards, right? And our attitude was very much like you, right? To the whole world, right? And I think it's possible that we may hold some of the strongest cards, but to assume that we hold all the cards when basically the rest of the world is our banker, I think that's a little dangerous. And I think, I've got a lot of respect for certain people who work in the administration. And I think they truly thought that they could take the pain up front and that we get a little adjustment period. Maybe we get a correction in stocks. Maybe we'd end up with a slight recession, but come like end of Q3, Q4 of this year, we'd be emerging into, reindustrialization and strong capex growth and a rebound in equities. And we would have got yields lower. So housing would be recovering and, we'd be able to return out some of our debt. I truly think that's what they thought. And then what they discovered was if you undermine the dollar and everyone is long US assets, then bond yields don't necessarily fall, they rise. Right. And I think that is the thing that's really thrown them, a curveball. And I think now they're going like, well, maybe we just punt this to the next. We do the classic US thing where really we only have 6 to 9 months where we can do anything before we have to consider the next election.
I forget who was it. Was it Kissinger that said that America always does the right thing once they've explored all other options?
Exactly.
Churchill, maybe.
Yeah.
Maybe Churchill.
Yeah, exactly. Churchill. But I mean, look, that's sort of where I think we are. I think we're just at the beginning of. I think this is. I was on the phone to a big real money account, a number of 2 or 3 months ago, and I said, it was this classic sort of Zoom call where there's like 30 people on the Zoom call and me. And I was looking at it, and it was there was one older person, 40, 38, 40 maybe, and then this sort of United Nations of pretty young things, super bright kids who've obviously got a Yale and Harvard and blah, 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 right? And I got off this call and I said, if I can leave you with one thing, is that while most of you've probably only been in markets since the global financial crisis, so you've only ever seen stocks go up, you've only ever US stocks outperform, you've only ever seen the dollar go up, right? What the Trump administration is trying to do, I think you may look back in 30 years' time at the end of your career, and you may say this was a period in history. Like this was truly a transformative event. And in that scenario, what you don't do is assume that you buy something at one standard deviation divergence from the mean. You back up the truck at 2, because this could go to a 5 or a 6 or a 7 standard deviation divergence. And we could just be a major total reset period, right? Where for the next 5 to 8 years, we end up with a weak dollar and US assets underperform in foreign currency terms. And that's important, guys, right? Even if you're sitting here just going, I'm a US investor, I don't care, you will, right? Because your purchasing power deteriorates, right? And if you're a wealthy individual, you don't really want to be, going to not being able to afford to go to Europe, right? Or buy rich wine or buy that German car, right? So these things are important, but that's what I truly, truly think. I think we're at one of those periods in history. They're backing off, and could they punt it for 9 months? Maybe, but it just looks to me like we've broken Humpty Dumpty. The money is beginning to hedge up its dollar exposure, the foreign money hedge up its dollar exposure on the margins, get back to benchmarking US assets. But that dollar is really important, because even if they just get back to benchmark and they're not hedged, they're going to find out they're going to be losing money. And that's when you start to go under benchmark, or, you get redemptions in, retirement funds from Europeans who go, what? I'm down in my Nvidia holdings in euros, right? So these things, I think, are just huge. I just think we're at this point, like, I'm not going to look back at the end of my career because I'll be dead. But, at some point, I think people will look back at this and say, wow, this was one of those periods in history.
Well, because we haven't yet had the proper liquidation phase of this transition, as we were discussing a moment ago, where are the biggest vulnerabilities from an asset class perspective that you see? It sounds like possibly the treasury market, but maybe U.S. bonds as a whole. But I find it hard to believe that they would capitulate and undergo a massive bear market without U.S. equities also suffering. So are those the two major asset classes that you see suffering the most in this liquidation?
Yeah.
And where would be the opportunities in the second phase once the sell-off happens and opportunities start to arise from?
So I think US asset underperformance, I think, right, in other currencies. I think that's what I see. I see, US bonds. I mean, you're absolutely right. I mean, do I think, US 10-year yields are going to 7%? No, right? But do they go to 5.5%? Entirely possible, right? I think that's actually, there's a neckline on 10-year treasuries right here. And if we break through that, I think it's 5.25 is the target, so another 75 basis points. I think US equities underperform in euro terms, in yen terms, in gold terms, in everything else, right? And so to me, I want to since I want to preserve my overall net purchasing power wealth, I want to sell US assets, right? That do well when the dollar is strong, right? And historically, that is, if you look at it on a sectoral basis, it's obviously the broad US equity market, but it is tech, healthcare, financials, consumer discretionaries. Those are the worst performing sectors if you go and look at them from 2002 to 2008 when the dollar was weak, right? The best performing sectors are the stuff that no one really owns, which tends to be precious metal miners, minings, metals, minerals, energy, right?
All commodity related sectors.
All commodity related. And then, emerging markets typically do quite well. As I said, at that point that the Fed starts to cut and that nice liquidity goes into the system.
Also right? A commodity play when you think about it.
Yes. I mean, it's very much a weak dollar cycle play, right? I would, when I was doing Real Vision with Raoul, we used to joke, like, if you can get the dollar right, then you just go and buy emerging markets and commodities and go and sit on the beach for 5 years.
Well, that was the 02 to 07 playbook.
Yeah, absolutely. And I think it's possible we end up in that environment again. I just don't think it's yet. I still think we're in that. If I go, is this the nice bit or the nasty bit of that capital rotation? I'm still that we're in that nasty phase. So I think you have to be bloody careful.
What are the catalysts that you're looking for the nasty bit to ensue?
I mean, look, it could be, if I worry that, as I said, we've pivoted from this sort of Trump 2.0 agenda, this highly laudable agenda to onshore, improve a lot of the middle class, reduce the twin deficits, to much more of a 1.0, who cares? I'm just a good guy, up stocks go. And in that situation, you pivot from being worried about the immediate worries around the US equity market, right? In nominal terms, not in, foreign currency terms, but immediate concerns around that, to being worried about the treasury market, right? Because you can't have a country just continue to spend like we do, where there's unquestionably inflation pressures coming through from tariffs, where we have 4% and change unemployment, and think that we're going to accelerate growth without inflation. I mean, that's just a joke, right? An absolute joke, right? We have never successfully reaccelerated growth from the current levels of unemployment without inflation. We tried it in the late 60s. It was a bloody disaster, right? It was the beginning of the trend that led us through into the 70s inflation. That started in really 1965, the foothills of that trend. So I think, that's kind of where I right here, right now, I'm focused on that treasury market and the dollar, because the dollar, if we are seeing another leg lower in the dollar, we saw a big move in dollar Korea overnight. It looks like dollar stock is going lower again. I'm worried. The dollar NOK is breaking lower, so dollar against the Norwegian krona. I'm watching dollar CAD, huge exposure to US assets. And I think it's the next Taiwan where these guys, where the Maple 8, as they're called, the big real money accounts in Canada, I bet you they haven't hedged anything, right? And, they've got 12% of GDP in US assets. I think good luck, when they try and start hedging all that stuff. So, so I think I'm looking at the treasury market and I'm looking at the dollar, because the dollar will just, if the dollar starts to weaken, maybe US equities hold up here and they don't go down in dollar terms. But like I said, I don't want to sit here in 5 years' time and have a US equity market that's at, 7,000 and yet the dollar's 50% lower.
Yeah, I mean, in Canada too, you've got an accelerating crack in home prices, an impending, potential major capital call where people with a lot of home-based wealth who were a little bit over leveraged and also have, retirement properties in the US are going to be forced to liquidate and bring that capital home. You've also got a cracking housing market in the US on just unbelievable unaffordability.
And in some of the markets, they probably own a lot of that stuff. Adam, in Florida and stuff, on overbuilt.
Yep.
And in Canada in particular, unlike the US, you have to refinance every 5 years. You're not allowed to lock your race for 25, 30 years like you do in the US, which is mind-boggling to both Americans and Canadians when they realize that the other current...
Look, the way this bond market's going in the US, we're going to be doing the same thing. You're not going to get a mortgage beyond 5 years if this thing keeps going, right? Because you're not going to be able to afford it.
Yeah. And then, of course, we've got the Japanese. I think the Japanese bond market's going to be interesting to watch too here.
I think we're in a struggle. I've been saying since 2016. I mean, the COVID, obviously was the exception. But the demographics of asset purchasers, so those people who are working and saving to their retirement, right, peaked in 2016. That was the low in global bond yields. That's when absent COVID, that was the low in global bond yields. And you could mask it with QE and yield curve control for a few years. But the structural trend from here on out is, as people of my age start to retire, right, is to go, okay, well, I'll just start living off my income, my savings, right? And so you just divest those savings, and that's when assets go down, they don't go up. I mean, and that's going to create a lot of problems for a world which is going into it. I mean, if we were going into it with debt to GDP ratios of 20% or stuff like that, then we'd be like, government can fill the gap. They can do this. That's the nature of Sod's law, right? It's going to be great for macro, though. Great for macro. Might delay my retirement.
That we haven't touched on, anything across the major jurisdictions or asset classes that are flying under the radar that you have spotted as potential asymmetric opportunities?
So I quite like, I've been toying around with some of these Latin American currencies and the equity markets in those currencies. I do quite like those. I'm watching things like, one of my clients asked me, what's your bottom draw trade? And I was like, I really want to own Vale, the Brazilian mining company in Brazilian real, right?
I haven't heard that in a while. Holy, I'm from Brazil originally, so
yeah.
yeah.
So I want to own that. And I've been toying around with Japanese banks. I think those look pretty cheap in dollars, in yen terms. I'll take the currency risk because I want to, to see that. And so I think those are it. I really want to buy silver. I'm gagging. I'm so gagging to buy silver, but I can't because I still think we're in that nasty rotation phase, right? And it's quite hard, even, me to sort of sit there with a short S&P position against it, right?
Yeah. Okay.
So yeah, look, the only other thing I would say is, what's going to determine the next leg down, I think, is at what point we get that capitulation trade. I mean, most of this rally that we've seen in US stocks has been either systematic, vol sellers, risk parity guys releveraging, CTAs getting long, and then US retail, right?
So the US retail has started to look abroad, start buying ET and emerging. Oh, I was going to say
heritage, right? I mean, sacrilege, right? I mean, I don't know. And heresy, right? I mean, I don't know whether that's. I know that there was something this morning that they've lightened up a little bit on some of their positions. So look, until those guys capitulate, that's to me the big capitulation event.
Yeah.
I mean, we sort of short stocks in November, December, and advocated that to our retail clients. It was quite hard to construct it from a professional, institutional perspective because just the risk rewards were quite tough to do. But we advocated 5,000 as our sort of initial target. So when we got down to those levels, we advocated closing that. Now I didn't go long, but I didn't go long because I just, I write research and I can't all of a sudden go, right, I'm sure I'm long, I'm sure I'm long, I'm sure I'm long, right? But within our trading, with our alpha capture book that we run, we can do stuff like that. And so we're now looking at starting to build up the short dollar position again, the short treasury position again, the short stock position again, but cautiously, and we'll build into those.
Phenomenal. Well, as usual, an unbelievably informative chat.
Thank you,
Yeah,
Jim.
this has been great.
Thanks, man.
Pleasure.
Again, for those who tuned in a little late, this is the great Julian Brigden, founder and president at MI2 Partners. And it's always great to have you on, Julian.
Thank you very much.
Again.
Thanks, Richard. It's been a pleasure.
Look forward to the next one. Thanks.
Cheers. Bye-bye.
I did want to take a quick second to remind our listeners that the team works really hard on these podcasts. We spent a lot of hours trying to get the right guests, and we do a lot of prep work to make sure that we're asking the right questions. So if you do have a second, just do hit that subscribe button, hit that like button, and share with friends if you find what we're doing useful.